You're restructuring your financial life for the next 5 years, and you need to treat this seriously. Too many people are looking at this like, I'm going to shop for an interest rate, and that's where they're losing. And that's where people lost before, and that's where they'll lose again. Ultimately, if you're not looking at this from a strategic long-term approach and how you're...
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Well, hello there. Welcome back. Welcome back to the podcast. Alex McFadyen here, your host, your favorite host. And today we're going to unpack the most important thing that's happened in the last week. No, we're not talking about Carney and Trump. And no, we're also not talking about interest rates today. Well, kinda. The reason we're talking about some of the stuff here today, but not completely, is because a big report was dropped, and it was CMHC's Financial Stability Report. And if you are a homeowner or a potential homeowner or in real estate, this is a must listen episode because there was so much data. I could probably do 6 separate podcast episodes on this information alone, but I won't. I'm going to try to summarize some of the key points in this episode, and I'll drop a few more in the coming days with some of the additional information that you need to know. Listen, right now we're talking specifically primarily about mortgage renewals, which comes down to what's happening in the income space with income pressure, debt levels, global trade tensions, and lending policies all colliding together in one colossal space. The data might surprise you, and some of the strategies that I will talk about today could literally save you thousands of dollars, and most definitely should be saving you a lot of money. Before I go any further, I got one ask for you. I spend every single Sunday digesting this information so it's ready for Monday or Tuesday whenever you're listening or watching this. My one ask for you is, if you're finding value from this episode, to go and leave me a great thumbs up if you're on YouTube, if you're on Spotify or iTunes. Give me a 5-star rating and pass it along to someone else that you think would find value from this content. Let's get right into it, not wasting any time today. We're going to talk a little bit about the first major factor, which is, what is the BOC actually worried about in their stability report? Remember, there were literally pages on pages of data and information, and nobody wants to spend all day weeding through that, at least most people. So I did it for you. And here's some of the things that I picked up in this report, in my opinions and directions on it. First of all, the Bank of Canada, in a way, is sounding the alarm, but not in a complete panic. They're telling us where cracks could form before we actually see them, which is so key and helpful as it relates to predicting for the potential challenges that we face. This is massive. I mean, I talk every day with borrowers about not looking at today, but looking at what could happen 3, 6, 12, 18 months down the line. And this is what they're basically doing with this particular report. Now, let's go through some of the key concerns on the report itself and what it all could mean to you. Number one, household debt remains high, elevated. This is probably not a shock to anybody that's living in Canada right now. It's expensive to live, and the cost of living, realistically speaking, hasn't significantly declined. Household debt has so far increased considerably over the last couple of years, and it still is high, even though it's not as much, or it hasn't seen as much pressure as we saw in 2023. Couple stats for your information and viewing pleasure for all the stat nerds out there. The current household debt to disposable income is 173% right now. That means 173% if you factor in $100,000 of income. They currently have $173,000 worth of debt and liability right now. Now, this is actually down, believe it or not, from 2023, which was at 179%. So while it might not feel like as much relief, obviously everybody out there who had a variable rate mortgage is seeing the come down. And if you have a fixed rate mortgage and you took a loan during that time, and if you're one of our clients, you've probably seen your costs go down as we've been refinancing people in that capacity. Well, this basically means for every $1 of taxable income, a household owns $1.73. I know I repeated that on the annual income, but taxable income is significant because, as we know, if you're in a tax bracket of 40 or 50%, that means that this $1.73 is not reality for you. it's something closer to $2.30 or $2.40 of debt per dollar. And that's a problem, and something that I think the Bank of Canada is aware of. And I sure hope that nationally speaking, our government is aware of, because there isn't an easy way to dig out of this mess. And you sure can't spend your way or tax your way out of this sort of thing. Now, a couple other key points. Housing values are still elevated in key markets like BC and Ontario, which is creating obviously higher overall balances. Now, despite the fact that we've seen a softening in the marketplace as far as real estate is concerned in some of the markets and some different types of properties across the country, overall real estate values are still elevated compared to where they were 5 years ago. Some of the other factors that are playing a part of this in terms of concerns, obviously, guys, and we don't want to talk too much about it here, but the trade policy volatility. BOC flagged the U.S. policy as a major financial risk sector. Basically, the fact that it's completely unpredictable right now on its own is considered to be a major risk, because it's very difficult to predict forward what the best approach or right approach might be when you don't know what the potential outcomes were going to be. So BOC has most certainly flagged that as a consideration. And a few thoughts or a few notes that they put in there is, and this is relatively straightforward for some, but not for others. Trade shocks equal job losses, which equals income strain and higher defaults. And that could lead to mortgage portfolio stress, meaning people having a harder time making those mortgage payments, whether they're homeowners or they're renters. Now, more on that a little bit later, because there were some interesting stats about debt per household of home ownership versus debt per household of non-home ownership. Now, the other factors here is that because of these trade uncertainties, it's more likely in export high areas like BC lumber, Ontario auto sector, right now, Alberta energy services and more, which from a takeaway perspective says that we have some vulnerabilities very regionally in our country. And so when we're talking about national things like national reports, it's important to remember that if you're in a different location or city or income type, that this may not actually impact you directly, but there will be an indirect impact of having this. Now, some of the takeaways that if you're in the real estate space, for example, that one of the takeaways that I would have for you is that you should really clearly understand, and this applies for anyone in the financial sector, understand which industries that your particular clients work in. If they're trade dependent, they might face double exposure of job risk and mortgage renewal. Now, one of the things that we've seen, a lot of the clients that we work with don't have a significant job risk, but we did see one of our sectors of clients have some job risk a couple of years ago, particularly in the online sector, where some of the highly paid engineers were seeing their jobs exported to different countries. And during those times, what happened is the banks were actually taking it upon themselves to adjudicate some of these companies. So basically means they were going to look harder at people who worked for some of these companies more than they would have, typically speaking. And this is already happening in places like Ontario for people who work in the auto sector and manufacturing space, where some of the banks are dropping guidelines and essentially reducing the amount that people can borrow in these sectors. Now, is that a sign for things to come? Probably. And likely, because quite frankly, the banks aren't there for you. They're there to mitigate stress for their key stakeholders and those who are looking to make money. Let's move forward here. So the stat that's getting really everybody's attention is that 60% of Canadian mortgages are set to renew in 25-26. 60%, 60. Now, unsurprisingly, 2020 leading into 2025. It's been a big year this year, but rates didn't really hit their bottom, so to speak, until 2021, which means that that was a year that most people were refinancing and redoing their mortgages, which means that 2026 and 2027 are going to be the big ones, particularly 2026. A lot of the borrowers that were getting mortgages, I mean, if you're one of them, you were taking on mortgage rates of 1.5% and 2.5% if you were in a fixed rate term. And even if you were in a variable rate, one of those people that got 1% variable rate mortgages and you had a fixed payment, well, your payment's probably still a lot lower than it might be otherwise, and you might not have paid off as much principal at that time. And so essentially, it could have a pretty large exposure to your financial situation. And, you know, for example, if you took on a $500,000 mortgage at 1.69%, your mortgage payment could have been around $2,030. And at today's rates, and this is really key to note that it depends on how you're structuring this, to be clear. But at today's rates, that could equal approximately a $800 increase in your monthly payment. Now, that's based on the assumption that you went from 25 years to 20 years. And that's like a $10,000 difference in monthly payments. Now, I don't anticipate this to be the case for all borrowers. And in general, don't believe that most people are going to be in a position where they're going to see an $800 payment increase. But I have come across a number of them already that are experiencing this kind of pain. And, speaking of pain as it relates to the renewal process and what's going on, and this is where we're going to talk about strategies, and I'll obviously dig into what you can do about that. The BOC's latest model suggests that average payment increase in 2025 will be closer to the single digits. And a big part of that is because of the fact that we've seen interest rates come down from where the last projections were in 2025. Now, I've got a chart in front of me that shows that in 2024, they were indicating that the change in payments at renewal was going to be significantly higher for most people, almost double the potential outcome that we would have seen today. So in short, although there is going to be payment shock for those borrowers, looking into the future, there's a situation where you're not going to see that same level of shock, though it will hurt a lot of families in the long run. What's interesting is that about 20 to 30% of borrowers will still face double-digit payment hikes, and particularly those rolling off those ultra fixed rate terms who are coming into lower amortization schedules. But where I think the pain is going to hit the hardest based on these trajectories and these reports are obviously first-time buyers from 21 and 2020, and variable rate borrowers, I mentioned, who are on static payments, who did never adjust their payment or make any lump sum payments or anything of that nature. Those are the major areas that we're going to see the most significant impact. In addition to that, we're probably going to see a major impact from homeowners who have high non-mortgage debt, which could include car loans, credit cards, credit lines, and other debts like that. And moreover, we have seen self-employed borrowers who are on stated income programs taking interest rates of 2.5 to 2.9% back in that time, which was crazy at the time, getting into payments closer to around 5.5 or 6%. Again, these are different areas that will see these payments potentially being negatively impacted. So even if the bank says the average increase is small, the personal payment shock might not be. If you're someone who has a renewal in 2026 or 2025, a couple things, or 2027 for that matter, I recommend doing a mortgage calculation. You can use a mortgage calculator on our website, which is highly accurate, getflowmortgage.ca. It's much more accurate than the ones that you're going to find on the bank websites and much more friendly to compare different options. Go on there and get an idea as to what your monthly payment would be, because that's going to be something you need to consider in your new budget. Again, we'll talk about what you can do about that step by step and how to approach that. But again, I think it's preparation, which a lot of people aren't doing, which is why there is some level of concern or shock when you look at some of the data and information that is presented in a lot of these reports. I'm just pulling up the reports right now and having a look. And basically, one of the biggest concerns that I've noticed already, just to kind of speak to this, is that most people aren't taking the time and the energy to explore their options. They're just kind of taking a renewal as the bank offers it, and they're looking at everything as a negative. The banks are basically saying, here's your renewal offer. If you find a better rate elsewhere, we'll match it. But there's really no inherent value in that, because there's no strategy, there's no restructure conversation, there's no total debt analysis. Nothing like that actually is happening in these circumstances. But let's get into exactly what you got to do. So I'm going to walk you through a process, 5 steps that you can take to set yourself up for success if you or your clients are in a position where you're looking to renew your mortgage. Number one, you got to do a little bit of a timeline audit. Not the most exciting thing on earth, but you got to look at your maturity date. It blows my mind how many people have no idea what their maturity date is. And when you think about it in the long run, this is a significant date for you as it relates to your mortgage. So figure out your maturity date. And if you're 12 months out or less, you can start acting now. There is a lot of upwards pressure right now on interest rates, and we've seen people take action recently because of concerns of the fact that rates are going up and deciding to lock in today or refinance today instead of waiting to the end of the term. You can lock in a rate 4 months from now to set yourself up for success. Now, if you're 6 months out, then this is where you should definitely be looking at getting a rate hold and looking at a switch option. Again, same thing. You can lock in what's available today. And if you're within that 2 month or 3 month window, you're just going to pay interest to the maturity date, which is relatively low depending on how much you owe. Now, number 2 is to understand your actual income trajectory. So this means understanding your current income situation. Has your household income increased since 2020? The average Canadian household has, but not everyone has. So we need to know where you stand financially at this point right now. If you haven't seen an increase or you've seen that gone down, then you might struggle to qualify with the new interest rates. Remember, the stress test is higher and people qualify for less money than they did back then. And if the answer is yes, then you might have the option to actually restructure your debt, which could be including the high interest debt in a way that doesn't mean you're paying it forever. There's some strategies to consider there. And in addition to that, re-amortizing the loan. A lot of people look at this as a big negative, like re-amortizing to 30 years. It's a tool. It gives you the ability to reduce your monthly payments and put you in a position where you can choose what you want to do with your debt. And so for all intents and purposes, resetting your amortization could reduce your monthly payments by 20 to 30% compared to where you could be right now. Again, I don't recommend using the refinance or reamortize forever unless you are using this from a tax savings and efficiency strategy or a qualification strategy. But I certainly do recommend putting yourself in a position where you have these options to help you in a time of need. The other thing you can do is you can consider different types of products. So number one would be to look at a home equity line of credit for cash flow flexibility. Maybe you currently have an investment property, or you're looking at purchasing investment property, or you're looking for different ways to reduce your taxable income. There are some different debt strategies that you can employ with the help of a very good mortgage professional and a very in tune accountant, like a cash damming, which is not exactly the Smith maneuver, but relatively similar wavelength as far as a way that you can reduce your taxable income. Now, this is definitely not for everyone, but these products can help you get there. You can also consider different types of static payment products that are out there. Of course, readvanceable mortgages are a key consideration in this type of a market, particularly mortgages where when you pay them down, they can be reborrowed in the form of a home equity line of credit. They're not right for everybody, but there are different variations. I think a lot of people don't understand there's different versions of these products. So whether they be with a conventional bank or a different type of bank, there's different options that would be available. Now, if you're concerned about where rates are going in the future, then you can consider some kind of like a hybrid approach where you split your fixed rate and your variable rate like 50-50. So you could say, I want to put $150,000 into fixed rate and $150,000 in a variable rate, which gives you the ability to split and spread the risk and basically give you an opportunity on the variable rate side, but reduce the risk on the fixed rate side. Basically, if you haven't considered any of these options, which I don't think most people have, and your bank certainly isn't telling you about these options, you should be reaching out to a team like ours. If you want to find out more information, just click the links below to get these options available to you and to make sure that you have the best possible outcome as it relates to your mortgage. Now, last but not least, again, we talked about pre-renewal refinancing. Of course, if rates drop in the last 6-12 months of the term, breaking early might make sense, but not always. We run a cost analysis to make sure people aren't doing this just because. We don't want to sell people on a strategy that doesn't make any sense. Basically, the takeaway here is you're not like, there's a thought, it's like, I'm negotiating a rate. That's not what you're doing here. You're restructuring your financial life for the next 5 years, and you need to treat this seriously. I think too many people are looking at this like, I'm going to shop from bank A to bank B for an interest rate, and that's where they're losing, and that's where people lost before, and that's where they'll lose again. Ultimately, if you're not looking at this from a strategic long-term approach and how you're managing this money every single year and getting triggered like you would with your financial strategy or financial advisor, then you're working with the wrong bank or the wrong person. And well, banks don't do this, so you're probably working it from the wrong bank. All right, that's a good insight into what you can do. Let's talk a little bit about what's going on with the bank world and what's happening outside of this from a long run perspective. Number one, are the banks safe right now? Despite everything we said, the Canadian banks are not in trouble. In fact, the BOC stress tested 26% drop in house prices, and all of the major banks in Canada remain solvent, which, although we don't care for their profits as much as they do, it ultimately is a good thing for a consumer. All the big guys, TD, RBC, BMO, Scotiabank, et cetera, have strong capital reserves, which was a mandate over the last couple of years from a banking perspective, which basically means that they're not going out of business anytime soon, and we don't need to be worried about them. Plus, as I mentioned, they increased their loan loss provisions, which means they got cash in the coffers to not have to be worried about it. Delinquencies are still 0.2% below what the average was, and they are rising, so it's something to pay attention to. But we do see the possibility of some mid-sized lenders with a little bit of vulnerability depending on the lender type due to the exposure to quote-unquote risky borrowers, which is a tagline that's basically anybody who doesn't qualify for conventional financing being the situation. Now, if we go through a downturn, if we're in a position where the market continues to go down, and you're wondering like what actually happens, we'll probably see lending standards get even tighter than they are right now, which would be unsurprising, and less approvals in the marketplace because of that. I think we're going to see lenders reduce home equity line of credit limits. In fact, I think we're going to continue to see that going into next year. One of the reasons that people getting ahead of it now can benefit is obviously we haven't changed the rules. We've seen a couple of the major banks just in the last 4 months change their rental policies, change their line of credit policies, and this is reducing the amount of low cost interest to many consumers, particularly real estate investors. And the last thing is that any borrower who has bruised credit or who is self-employed is going to face a lot more scrutiny and have a harder time at renewal, which is sad but significant as it relates to the different options kind of looking forward. Lastly, let's look at this from a trade shock perspective. Is the country ignoring what could happen from this trade shock? Maybe, maybe not. We talk a lot about inflation, we talk about interest rates, but could we, the only thing that really is going to significantly derail our economy is these trade wars if they continue to heat up. And the BOC is looking at this very seriously. In fact, they brought up that a prolonged trade war or US policy shift could trigger more Canadian job losses, falling consumer confidence, housing prices drops, and rising arrears. Now, we kind of know these things, but they're pointing it out in their survey for people to pay attention to. In addition, we could see smaller lenders with more policy strain and, as I mentioned before, further credit tightening, which means house values potentially dropping. Now, this is always worst case scenario stuff, right? It doesn't necessarily mean it's going to happen, but it is a real consideration. And the big idea is that most Canadians will manage most of this stuff. They're going to be able to overcome a lot of these issues. But they will need to change their financial situation. They're going to change their spending habits, and they're going to have to be more diligent ever than before. It's not going to be enough now to continue refinancing over and over and over again, or just trying to ignore the fundamental principles of a mortgage. And those who are planning now will probably be fine while everybody else scrambles. So whether you're in the marketplace with as a homeowner, you're trying to figure out how to buy, or you're a real estate agent, I think, remember, this is not a rate discussion. It's about adaptability. It's about clarity. It's about taking action before the headlines get even worse. Last but not least, if you're a homeowner wondering what your 2025 renewal or 2026 renewal is going to look like, then we have a fantastic tool to help you out. It is a custom home report to show you an analysis and a planning proposition to show you how to save money and get ahead of it to reduce money like thousands of our existing clients. And if you're in the real estate space and you're looking for someone who properly serves their clients and brings them back to you in a better place than you actually found them, then we have a guide to help you. Just comment at the Mortgage Pug or at Flow Mortgage Co., and we'll send you the guide or the renewal strategy right to you. Thanks so much for listening to the episode. Try not to panic. There's a lot of stuff going on right now, but we're here to help you through the mud. See y'all soon.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.